Hey there, and welcome. If you're a sole trader, you know that amazing feeling of seeing that final profit number in your accounts. But here's the real question. How much of that profit do you actually pay tax on? Well, that's exactly what we're going to break down today. The journey from your business profit to the figure the tax office really cares about. So, let's jump right in. So let's kick things off with the big one. Is the profit your business made the same as the profit you're taxed on? For most sole traders, the answer is a surprisingly clear no. There's a really crucial translation step that has to happen first, and that's what this entire explainer is all about.
All right, first up, we've got to get our heads around the fundamental difference between two key ideas: the profit you see in your business accounts versus the profit that's actually taxable. They sound like they should be the same thing, but they serve completely different purposes.
And hey, just to make sure we're all on the same page here, when we say sole trader or sole proprietorship, we're simply talking about a one-person show. If you own and manage your business all by yourself, then yep, this is for you. This slide really lays out the core issue perfectly. On one side, you have your accounting profit. That's the real story of your business's performance. But on the other side, you've got taxable profit. Now, this isn't just a slightly different number. It's calculated using a totally different rulebook, strict tax laws, and it's the only number that matters when it's time to file your tax return. So, how in the world do we get from one to the other? Well, that brings us to our second section, calculating what's known as adjusted profit. You can think of this as the bridge that connects your business books to your tax return. A great way to think about this whole process is like a translation. Your accounting profit is written in one language, the language of business, but you need to translate it into the language of the tax office. And believe me, they have their own specific grammar and vocabulary. And here is the basic formula for that translation. First, you start with the net profit from your accounts. Easy enough. Step 2, you add back any expenses that the tax law says, nope, not allowed, and we'll dig into those in a minute. Step 3, you take out any income that isn't actually considered taxable business income. And finally, after a few other little tweaks, you land on your adjusted profit. It's a pretty clear 4-step journey. Okay, on to section 3. The biggest part of this whole translation job really comes down to one thing: expenses. The tax office is, let's just say, very particular about what you can and can't deduct. These are what we call allowable business expenses. So, the most important thing to remember here is the simple little acronym, REN. For any expense to be allowed, it has to pass a 4-part test. It must have been incurred wholly, reasonably, exclusively, and necessarily, all for the purpose of generating revenue for your business. If an expense fails even one part of this test, the tax authority will toss it right out. And that, of course, brings us to the flip side of the coin. What happens when an expense does fail the REN test? Well, those are called disallowed expenses, and you actually have to add them back to your profit. Let's look at some really common ones. First up, we've got non-cash and capital stuff. Now, depreciation is a standard thing in accounting, right? It shows an asset's wear and tear. But for tax purposes, you can't deduct it. Instead, the tax office has its own system for this, which they call capital allowances. Same goes for any costs you have when buying a big-ticket asset. Those aren't treated like simple, everyday running costs. The next bucket includes provisions and penalties. So you can't just deduct a general just-in-case fund for bad debts. It has to be a specific debt from a specific customer that you know has gone bad. And, well, it kind of makes sense that you can't deduct fines or penalties, right? The government is not about to give you a tax break for breaking the law. And this might just be the most important rule of all for a sole trader. You absolutely cannot claim any personal or private expenses as business deductions. The line has to be drawn somewhere, and for tax, you and your business are separate. Let's look at a real-world example of this. This quote just nails the point. In a case study from our source material, a business owner named Dr. Eniola had claimed all of her vehicle repairs, but the tax inspector pushed back, arguing that surely she used the car for personal trips too. And in the end, they agreed that 1/3 of the car's use was private. And that agreement had a very real monetary impact. That 1/3 of her total vehicle repair bill came out to 151,667 naira. That whole amount was disallowed. It had to be added back to her profit, which of course increased the amount of money she would ultimately be taxed on. It really shows how that personal split adds up. So, you've started with your net profit and you've made all these adjustments for disallowed expenses and other bits and pieces. Now for the final section, putting it all together to figure out your actual tax bill. The number you have now is your adjusted profit. But hang on, there's one more key step. Remember how depreciation was disallowed earlier? Well, this is where the tax office kind of gives back. You can now deduct something called capital allowances, which is the tax-approved way of accounting for the wear and tear on your major business assets. After you subtract that, you finally have your chargeable income. This is the number the tax rates will be applied to. Your chargeable income is then taxed using what's called a progressive system, just like you see here. It's not a single flat rate. Your first 300,000 naira of income gets taxed at 7%, the next 300,000 at 11%, and so on up the ladder. Your income gets broken up into these different slices, and each slice is taxed at its own corresponding rate. And there you have it. That's the whole journey, from your accounting books all the way to your final tax bill. It's such a vital process to get, because understanding this translation isn't just about compliance, it's about being in control. When you know the rules, like the REN principle, you can make smarter financial decisions all year long. Because at the end of the day, the smartest business